Is this now the perfect storm for gold and silver to break out? Well, joining us today is Northstar and Badcharts analysts who have been on the show before, who have made correct calls on Bitcoin and other commodities and assets. And we're going to talk about your Bitcoin call first. Patrick Karim and Kevin Wadsworth are joining us again today. Welcome back to the show, gentlemen. Good to see you both.
Great to see you.
Yeah, nice to see you again, David.
I've led with the fact that you've made the correct call or a correct call on Bitcoin. And let's revisit that call. A few months ago, May 9th to be exact, you came on the show and you said that Bitcoin would fall to at least $20,000 and perhaps below. Back then, it was still trading at $31,000. It was oscillating around that level, and you made the call that it would keep going down to below $20,000. Let's revisit that call, and let's update those numbers if you do have an update. Patrick, I'll start with you.
Yeah, well, Bitcoin at that's again the beauty of technical analysis is we don't have to worry about fundamentals, about whoever's spinning a positive spin, like is Bitcoin the next world currency? Like it totally doesn't matter. We saw that it was important. It broke down from a rising trend line, which is the first means momentum break. So when you break down from a rising trend line, momentum breaks, but often it tricks people because after that, there's like a Neko move back up. And then people, we're in the clear. But it refuses to do a new high, and then it tumbles down, breaks below horizontal support. And like Kevin identified on the chart, once you're below that, you have to favor more move down until the chart proves to you otherwise that it can close back above those levels. And until it does that, the bias has to be downwards.
Okay, but I'm curious to how exactly you reached $20,000. Patrick, maybe you could elaborate on the target there, or how you arrived at the target.
That was just in TA. So we knew as fast as it went up, not a lot of buyers. So there was a vacuum. When it broke out above $18,000 or $19,000, it went up fast. It created a base on top around 40, 60,000, 30,000. And once you break down below that, there's not that many buyers that bought on the way up. So it just vacuums all the way down back to the previous base. And that's what we call a reverse symmetry move. So that's one of our techniques that we could use in TA that we know, okay, there's vacuum. It's going to go all the way down. And then when there's that huge base where people previously believed there was a low watermark for Bitcoin, it hits it again. And then after that, it starts bouncing around that area until the market decides if it wants to try to go down below those levels or try to bounce back up.
All right, Kevin, let's get on to the outlook part. So do you have an outlook or an update to your Bitcoin call? I mean, again, we've reached your target at $20,000. I think the question is whether or not this is the bottom that we've seen.
Yeah, so the Bitcoin simple summary chart that I put out back on May 9th or around May the 9th, as you say, took us down to around about 20,000. I had a series of staged targets, 30,000, 20,000, and then an ultimate target that took us to somewhere around 10 or 12,000, David. Looking at the Bitcoin chart now today, we find ourselves in an inverted arc. So this is the opposite of a cup pattern. It's a sort of a dome-shaped pattern. And we have been rising, as Patrick just described, in a bit of a bounce off that 20,000 area. And it's taken us up and formed a bearish rising wedge hitting resistance. There are a number of technical analysis techniques and features of this chart which make it more probable that this is going to break to the downside and head down towards that 10 to 12,000 target. I would assess the odds at around about 70 to 80% likely that we break down to see these lower lows, and around about 20 to 30%, excuse me, around about 20 to 30% probability of moving to the upside. So we can't rule out that upside move, but knowing where the support and resistance levels are is going to give us that really early heads up. So those are all marked on the chart for people to see.
All right, so Kevin, I'll let you elaborate on the price targets that these charts indicate based on the arc patterns.
Yeah, sure. So we're heading in the direction of the 30-week or 200-day moving average. Those are both very similar in value, of course. And that's somewhere just above $30,000, $32,000, $33,000, that kind of area. By the time we move up to meet it, I guess we could be somewhere around $29,000 or $30,000. So that is the upside target, and that's the highest I would expect it to get. We may well start to run out momentum before then and begin to roll over. I noticed quite a few of the cryptocurrencies already doing that and seem to have put in their highs for this, what I'm seeing as a bear market rally. So we're either at or very close to those peaks at the moment.
Yeah, Patrick, I'm seeing a lot of hopium headlines, if you want to call it that, on the internet. Mike Novogratz, CEO of Galaxy, saying Bitcoin will eventually one day reach $500,000. You've got people like Anthony Scaramucci saying that if it goes to $300,000, why does it matter if you buy at $20,000 or $60,000? So basically, a lot of large institutional investors are still very much bullish long term. Do your charts give you long-term projections, or like Kevin said, $31,000 is the medium-term price target? Can you look beyond that? Is that a technique that can be applied?
Yeah. Well, there's two things you got to remember about Bitcoin. It started, I think we talked about in our previous interview, it started in 2011. That's the charts. So it started at the inception of the NASDAQ, the tech bubble, right, market. And right now it's tracking that. And you got to remember right now, if we go in an inflation period where they're just devaluing fiat and we're just adding zeros, right? Because everything, let's say in the 1970s, a barrel of oil was $3, and then after that it was 20, and then 90, and then whatever it goes up. You have to start measuring stuff in adjusted for gold, adjusted for silver, adjusted for something other than fiat, right? Because nominally, let's say we're going to hyperinflation, Bitcoin targets, of course, if they could nominally stay afloat, even go higher. But then after that, if gold goes up higher or faster than Bitcoin, do you really want to hold like Bitcoin or any assets, that are just adding zeros to it?
Okay.
So we saw the SPX broke down versus the producer price index, or the Dow Jones Industrial Average break down versus the producer price index. And every time that's happened previously in the past, there's a whole bunch of other events that came from that. Then after that, gold broke out versus SPX. And after that, if gold breaks out versus SPX, silver tracks that ratio chart to practically perfection. Miners, all that type of stuff starts going up. Once the capital flows, they start shifting away. So Bitcoin, the way we see the chart right now, like Kevin explained it, it's looking a lot like the NASDAQ chart starting to roll over, or NASDAQ priced in gold. So it's nominally, it's very hard to see higher targets for Bitcoin, very hard.
That's exactly my next question, actually. And I think this is a good time to move on to stocks, and then we'll talk about gold at the end. Before we move on, if you're watching, give us your gold and silver price forecasts, comments down below. Let's see if you match up with Kevin and Patrick's forecasts. So I think it'll be very interesting to see what people write in the comments. I think let's see if people are if they share the same sentiment as you. But all right, continuing on the thought of the Nasdaq being correlated with Bitcoin. So you're anticipating Bitcoin to go to $31,000. That's not a huge increase from where it currently is. Can you apply the exact same percentage gains to your Nasdaq analysis, for example, given how correlated the Nasdaq and Bitcoin have been together? I'll let anyone take that question.
In broad terms, yeah. I mean, until proven otherwise, cryptocurrencies and Bitcoin are a play on tech stocks, and that's maybe partly due to the fact that cryptocurrencies haven't been around for a huge amount of time. So we just don't know how they're going to behave if and when the stock market's going to a much more prolonged and serious decline, rather than just the usual short corrective phase that we've seen over recent years. So if we have a repeat of the sort of thing that happened in the 1970s, and we see downward to sideways trending stock markets for a number of years, we just don't know how cryptocurrencies are going to behave in that kind of environment. So this is where the technical analysis comes into its own, because you don't need to worry about what the narratives are, what the fundamental stories are, all the arguments that are going on Twitter and YouTube and all that kind of stuff. The technical analysis will tell you, it'll tell you straight away if Bitcoin and cryptocurrencies are doing what they normally do and what they usually do. And by the way, that would mean them finding a low point sometime during the final quarter of this year or the first quarter of next year. That would be very normal. And then for cryptocurrencies to go onto a new leg, a new bull run to new all-time highs, that would be the normal. If that starts to look as though it's not happening, and if NASDAQ continues to show weakness, and by the way, the stock markets are also in a bearish rising wedge at the moment, then it means that as far as evidence is concerned, the cryptos are just doing exactly what the Nasdaq and the stock markets are doing, and they're not capable of decoupling from the markets. But gold and silver, of course, would be expected, and commodities as well. And for a whole host of other reasons, by the way, ratio charts and a whole host of other evidential analysis that we're doing, showing this capital shift, this flow of capital, and this share of capital that commodities and precious metals are getting, the share of the money supply is gradually shifting away from stock markets and away from general equities and towards commodities of various descriptions at the moment. Energy, commodities, precious metals, base metals, they're all taking their turn in the spotlight and handing the baton from one to the other. But that's where the growth is at the moment, if you want to put it that way, in the share of money supply, whereas the stock market is having it kind of seeping away at the moment. So right at the critical moment right now, as we're pushing up against resistance levels, both in crypto and in the stock markets. So it'll be sometime in the next 2, 3, 4 weeks where it'll be much more definitive answer as to whether we are breaking down or breaking to the upside. So the TA gives us the head start there. And by the way, as Patrick said, very, very important not to just measure things nominally. When you've got inflation at 9 or 10%, here in the UK heading towards 13%, we're told, don't just measure the nominal value of stuff. Fiat is, you can't just measure stuff in fiat. It doesn't make sense. You need to measure stuff with reference to inflation or with reference to gold. Otherwise, you're just referencing a paper currency that is losing value at 5, 10, 15%, and that just doesn't make a lot of sense.
All right, so Patrick, let's talk about the Nasdaq then. So if you're anticipating Bitcoin to go to $31,000, that's roughly a 30% increase from today's level of around $24,000. Are you also then assuming that the Nasdaq can increase by the same percentage, so 31%, 20%, 29 to 30%?
Well, yeah, I'd have to put up the chart and see how much up room it has. But I would, instead of taking how much Bitcoin would go up within its chart percentage and trying to apply that to NASDAQ, I would actually look at the NASDAQ chart and see where its levels are, where its resistance level are. Because now we've seen Bitcoin, and that's a lot of its attraction. It's like a leverage play on tech stocks, right? NASDAQ goes up 10%, Bitcoin goes up hundreds of percent. And on the way down, it's probably going to be the same thing, right? Or back on the way up. So instead of just trying to see how much if Bitcoin goes up, and then after that, there's another part of technical analysis that will be divergence. So Bitcoin, you could flip the script. So Bitcoin might go up a certain percentage up when the Nasdaq refuse to go that much higher. Then after that, you could start creating some divergence between using those two instruments to show underlying weakness in the whole like tech sector.
Okay.
I'm sorry about that non-answer, but you can't transpose like
yeah, no, it's a fair explanation. So stock market overall, the stock markets have been rallying tremendously since the beginning of July. In fact, this is the biggest single month rally in actually several months. And so I think some traders and investors are wondering if this if the durability of this rally is here to stay. In other words, is this the start of a long-term bull momentum in the stock markets? Kevin, I'll start with you.
If you're going to push me on that, I would say I suspect not, for the reasons that we've given, and for the reason that we are now at significant resistance levels, both in sort of NASDAQ and the S&P. We have carved out this bearish rising pattern in the stock market. So my feeling at the moment is that we are at quite a dangerous point as far as the stock markets are concerned, and crypto by extension. So I wouldn't be looking to take positions in the stock market at this point, and expecting limited upside moves, and limited and also unreliable upside moves. We've seen some pretty strong moves in some of the cryptocurrencies, but as I say, everything in the charts for me is suggesting that this is nearing its end rather than the start of a new strong move to the upside. But as always, the technical charts will inform us when we cross those thresholds as to whether we need to change that analysis. But at the moment, no, I feel that we're closer to the end of this stock market move than the beginning.
Okay. All right. Patrick, do you have anything to add?
Well, just like Kevin said, like there's like it's a weight of evidence. So let's say the stock market SPX broke down versus producer price index. It broke down versus oil. Oil, like I'm expecting SPX to lose like 90% of its value when priced in oil going like in the next 10, 20 years. It's going to be huge, even if anomaly it goes down 40% or whatever it is. Expressed in oil is going to go up so much higher than the real value of the SPX will actually lose like practically 90% of its value.
And this is what's showing in a lot of the charts, actually, David. No matter what SPX does, the ratio charts are suggesting that a whole range of other investment vehicles are going to outperform SPX by that kind of. I just seen the cat jumping onto Pat's desk there. Going to outperform SPX. So if you look at things like, for example,
don't push the cat away. I mean, invite him back. Maybe he's got some input to give.
He might have something to say, mightn't he? I suppose. Yeah.
Sorry, I cut you off. Kevin. Please continue.
So yeah, I mean, particularly when we look at things like energy plays and uranium. I have to mention uranium. I keep mentioning uranium. Looking at the ratio chart of uranium to the SPX, there's a whole range of other investment vehicles that look as though they're poised to hugely outperform the stock market. So the next few years, I suspect, are going to be incredibly, how can I put it, an incredible opportunity for investors who are able to spot these tidal shifts.
Okay. All right. So let's move on to the commodities then. Commodities have peaked a few months ago. We've seen base metals fall, agricultural commodities fall. So the big concern over the summer is whether or not food prices are going to continue rising to the point where food becomes almost unaffordable to the average person. But that problem seemed to have taken care of itself for now. We've seen the CPI come down from its previous high of 9.1% in the U.S. Headline CPI is now 8.5% in the U.S. The Bank of England recently, Kevin, you're based in England. I'll let you elaborate on what the Bank of England said exactly, but they're giving a grim forecast on inflation. I believe the Bank of England is also raising concerns now officially for a recession. Is that right, Kevin?
Yeah, so we've had a negative print on the most recent quarter, another one expected, and yeah, I mean 13% is what we're being projected now. We're currently sat at about 9% inflation, starting to lose count of the numbers now. But
that's even higher than what they emitted in the U.S. That's scary.
Yeah, I mean it is. I mean 13% is starting to get to
right.
Well, it is getting to 1970s levels, and I've been pointing this out for a number of months, looking at right the way across Europe, looking at the producer price index. Look at Germany. I mean, the PPI is way beyond the 1970s peak, way beyond CO2 peak. So what we're looking at is historical. It's historic in its proportions, and it's going to be historic in its implications. Here in the UK, we've got an enormous problem developing now with how on earth, average consumers are going to cope with energy bills of over £5,000 per year. It's just ridiculous. That probably equates to, I'm just calculating roughly in my mind, $7,000 or $8,000 US. People just can't afford those levels. The government are talking about bailouts. They're talking about bills that are larger than the bill for keeping the economy going during COVID.
Right.
I mean, this is just getting out of control, really.
Well, so where I was going with this, I'll move on to you, Patrick, is that commodities have been, I guess, softening in price as the prospect of a global economic slowdown looms. And I think investors are wondering whether or not this softening of the price is here to continue. In other words, is your outlook on commodities bearish? Because that's what the trend has been over the last 2 months.
Well, I'll tell you one thing. All the charts that I saw, whenever at the abyss of the recession, and this is, guys, I have to flip the script. At the abyss of the recession is when gold bottoms. It's when silver bottoms. Overlay the U.S. recessions as defined, from the data from the Fed. Every single middle of these recession bottoms is where gold bottoms before. Gold and silver will sniff the monetary imbalances required by the government to get you out of the recession. So for me, recession fears, I love it when people stop talking about inflation, because we were on the gold train in 2019 in June. Nobody was talking about inflation, and that was great. And we went up from 1,300 all the way to 2,000. And right now, I love the people talking about all this recession and deflation and less inflation, because that's where, from a mass media contrary point of view, if the TA starts aligning and people don't believe, they have a wall of worries, Patrick, in recession, silver can't go up, but then it keeps climbing up, keeps outperforming SPX, and the capital flows are going in commodities. Those are the best entries you'll ever get if you could see them with the charts. So for me, recessions, I welcome them. I want to see the recession because I know they'll open the spigots just to get out of it, and that will be rocket fuel for gold and silver and the rest of commodities.
You're right. I mean, in the past, the ends of recessions have been very good for precious metals like gold. Usually, though, not always, but usually during a severe recession like 2008, for example, gold falls along with other risk assets, though. So if, first of all, do you assume that this pattern will continue again this time? And if so, maybe we should wait?
Definitely we should wait until the gold to silver ratio breaks down. So gold silver ratio is a financialized instrument where if there's risk on of a market meltdown, of a spike, the gold silver ratio will crescendo up with the DXY, with the VIX. And right now I have a level and could show the chart that until the gold silver ratio unwinds, that means the market is not sure about the risk. So definitely I have a level for the gold silver ratio. Until it breaks down below that level, just observe what's happening. Once it breaks down below that level, it's game on. Silver and gold will outperform US equities from that moment on, and silver will outperform gold in the initial legs of the recovery phase of the US equities.
Okay. Kevin, can you add to Patrick's comments and maybe give us some color on the timing of when this might happen?
We're in a sideways trading range for gold at the moment, and it's got a floor at around about 1680, and the top is somewhere just below $2,000. And we've been in that sideways trading range for the last couple of years. So the level to watch is that sort of 1680 level. As long as we stay above that, and preferably above the rising 3-year moving average, I've got no concerns at all. Also worth mentioning that DXY, this thing that we keep talking about, the US dollar index, it's a nominal number. And people seem to forget that since that number, that DXY number has risen from 72 to where we are well over 100 now, gold has also doubled in price. So over a period of time, DXY has moved up from, as I say, 72 to over 100, gold has doubled. So it's wrong to make that sort of assumption that a rising DXY, which is just, after all, the dollar jumping up and down versus the euro, that's all it is. The dollar and the euro are trying to sort of win a competition inside a box, but that box is dropping like a rock because outside of the box you've got inflation going on at a much greater rate, and inflation has a cumulative effect. So no matter what the US dollar and the euro do to create this DXY number against each other, it can't counteract what gold does over time, which is to measure loss of purchasing power. So 1680 is the floor, around about 1980, 2000. But as long as we stay in that sideways trading range, I've got no concerns whatsoever. To me, this is just a staging post on the way to much, much higher values.
All right, so Patrick, what are these much, much higher values? Because you said earlier that gold is expected to outperform stocks. Well, that statement could be positive or negative depending on how stocks do. I mean, if stocks fall by 30% and gold goes down by 10%, you're still outperforming, right? Yeah. My point is, where is gold going to go? Is it up from here? Because outperforming a bad asset is not really a positive news in itself.
So it's twofold. So first, the first step is outperforming in any direction. Like you said, as long as gold is able to go down less than SPX, that's step one. But eventually, I'm going to show on the chart, there's a descending trend line. When gold breaks above that wake-up line or that early breakout line versus SPX and the levels that Kevin mentioned, gold is about, it can break out above its 1800, 1900, or 2000 levels. That's a game changer because now it's win-win. You have gold breaking out on its own chart, but not just that, because like you said, gold could be breaking out on its chart. But if SPX is kicking gold's butt and it's going higher and faster, why go long gold? So you want gold to break out on its chart, and you want it also at the same time to break out versus the SPX. And every time that's happened, it's a 10-year bull market for precious metals, silvers, miners, all that. The capital flows are leaving growth stocks for whatever reason, and they're going into commodities.
All right, so what's the next high for gold? Previously, the high was $2,000, close to $2,100. What's the next high? And by high, I mean the level that we reach followed by a correction, so a major correction.
Well, what's a measure move, Kevin? It's like 24, 2600 is the next logical. So if ever we break out, there should be a vacuum all the way close to 24, 2600 gold. And then after that, we could expect
number of ways of estimating that target, but they'll come out somewhere between sort of 24, 26, 2700. So mid to upper 2000s is where I'd put that level. It'll be very evident at the time when we're reaching the peak, because there'll be plenty of indications suggesting that we're stretched and it's time to exit. But I suppose, like a lot of analysts have identified, the area somewhere in the mid 2000s, 24 to 26 would be a good estimate at this point in time. We need to get through that 2000 level and close above it in order to find that we can come down and put in a major cyclical low in late 2023 or into 2024, you'll know that gold tends to put in a cyclical low every 7 to 8.5 years. And so we've got 2000, 2008, 2000, late 2015, early 2016. So of course, next one is the late 2023, early 2024. So we're very cognizant of that fact, and we need to clear the hurdle of $2,000 to have some comfort in knowing that we're going to come back down and test that sort of breakout level for that major low. Because the alternative is we don't break out and we continue in this sideways trading range, and then we see a significant drop below that, probably below that 1680 level. But the very fact that we're already sort of dancing around with a 3-year moving average should be a pretty good indication that we could well be quite close to that low, and it could be that we're putting in that low earlier than anticipated. So there's a number of possible scenarios here, all of which are being sort of analyzed very carefully by us, but we've got to cross those key levels. And I'll keep emphasizing this, as Patrick has said, we've got about 10 key indicators, 10 main key indicators for gold, and we need to see each one of those give a green light. At the moment, we've got about 3 green lights out of a list of 10, so they're gradually starting to turn green, but we're not there yet. And there's a little bit further to go before, as technical analysts, we can honestly put our hands up and say, okay, guys, we're on the way now.
Okay, so just to recap then, by 2023, you're anticipating base case $2,400 gold?
That would be the low side target once we clear 2,000.
All right. You know what I like about the arc patterns that you guys show is that they do in some way indicate timing as well, because by retracing the previous pattern and extending the arc, the chart is showing exactly when the price is going to be met. The target price is going to be met based on where the arc ends up, assuming the shape of the arc doesn't change, midway. Course.
Exactly. Yeah, I mean the arc is a support line just like any other, and support lines can be broken to the downside or the upside, but knowing there's a support line there, knowing the arc is there, and that on the majority of occasions they play out very nicely, it does give us a good timing.
All right, gentlemen, that was a great analysis. Thank you for updating us both, updating us on Bitcoin, stocks, and gold. Patrick, did you have something to add? I'll give you the last word.
You put me on the spot, David. How dare you? No, I have nothing.
I do have one last question for you, Patrick, but I'll let you I'll let you follow up on Kevin. Yeah.
I just want to say thanks for the chat there, Dave. I mean, it's really a key point for all investors at the moment. I think everyone's asking the same questions.
For sure.
Everyone's desperate to know the answers, and there are times when technical analysis really comes into its own. And I think the next few weeks, the next couple of months are going to be one of those times.
Okay, well, pivotal moments, and definitely look forward to keeping up with how prices move. Patrick, one last question for you. What is your cat's name? You can't just introduce your cat and not give us...
French. It's French. She's called Chef Win.
Okay.
Yeah, so she's a fun cat there, so... Yeah, she likes being on TV there on social media, just like me and Kevin.
Next time, just put the cat in front of you. We'll get more views. I'm actually not even kidding, but maybe for next time. All right, thank you, gentlemen. Thank you both again, and look forward to speaking next time.
Thanks, David. Bye-bye.
Thank you.
Bye-bye.